an update on the City Financial Wealth Fund in the third quarter. I'm joined by its manager, Mark Harris. Mark, good to have you with us today.
Hello, Jenny.
So let's start with the outlook of the economic environment we're in today. What would you say are the main points?
Following on really from the last time we spoke, I think we've characterised this environment well. It is a noisy environment, and there is this constant tension between good growth numbers, basically at a global level, a synchronised global recovery, first time we've had that in a long while, but really this conundrum over the lack of inflation, almost globally, and people starting to question, well, okay, the reflation is there, but why is that not coming through in the inflation statistics? And that one, only a week or so ago, the chair of the Federal Reserve admitted is still pretty much a mystery, which is problematic to say the least. But what I would add is, whilst we have characterised that environment, I think correctly, this sort of tug of war, as it were, we haven't always been able to sort of capture it most effectively.
Well, last time you were on, you were very confident about reflation trade. So how's that progressing?
I think that's really progressing nicely. Growth statistics around the globe are picking up. All the leading indicators are strong. PMIs, in particularly globally, are very strong. And basically, we're in a synchronised global recovery. The point being is, as we've often talked about, there's very little inflation. And that is a real puzzle to everyone. Now, we've got to the point where people are arguing that maybe just inflation isn't part and parcel of the cycle anymore. Maybe structurally we're in for a modest growth with low inflation environment. Now, in that scenario, that's really a Goldilocks scenario where equities and bonds can both do well.
So looking at the performance of your fund, I noticed that in September you did have a setback. So why was that?
Well, that's disappointing, obviously, given that we have characterised the background well. It boils down to three main things. I think last time we said bonds had been selling off, government bonds, quite heavily, and we were buying into that. And we'd done well up until literally the Fed meeting, where Janet Yellen suddenly comes out and is very hawkish, despite the fact that she can't really explain that there's no inflation. And that took markets off guard. It was a surprise. Bonds sold off heavily. And really, in essence, we round-tripped our performance. It went up quite a bit and came back down. And there were two other main factors in the period, and both of those occurred in September. We'd warned that we felt after a very, very long run of equity positive returns, there was a chance for a blip in equities, and that we'd take out some protection against equity falls. And I'm afraid, well, it's good for investors. Equities have carried on, but we've wasted some premium on buying some protective strategies or insurance against market falls. They are still in the portfolio, so if equities were to fall during October or November, they would still help us avoid a lot of those equity falls. And last but not least has been really the hurricane season. Now, for the best part of 5 years, I have owned something called CATCo Reinsurance, which in real terms is a reinsurer of reinsurers. That has delivered in excess, I think, of 15% returns per annum. It's a non-correlated asset, which is great for diversification in portfolios. But this year, as everyone knows, there's been a very, very heavy hurricane season, and that caused the fund to fall very dramatically in late September. And that caused us about nearly 70 basis points of damage. Now, then I guess people can say, well, why didn't you didn't you know something about that before? Well, we were reducing the holding a little bit before, but we didn't get rid of all of it. And now, really, we're actually looking to increase it because insurance rates, after these sort of damages, generally go back up. And this thing will offer us a very rewarding experience, bar obviously another natural catastrophe. So just to round that out, it was three effects. Our bonds giving back some of their previous outperformance, the CatCo reinsurance getting hit by the storms, and last but not least, really us being a little bit too negative over the September period on equities.
So how's your portfolio then now positioned? Any major changes?
There haven't been many other than those that I've just expressed, really. The main thing is we'd balanced the value and growth elements in the equities. We're still overweight equities. We've gotten just over 50% in equities. We've still got about 11% in alternatives. And the balance is really in bonds, cash and property. So very little from an asset allocation perspective has changed. What I would say is one of the things we have been noticing is a lot of crowded positioning in technology shares and valuations reaching quite heady levels. So we've been selling down or reducing our holding in Polar Cap Technology, and we're looking really at pushing a little bit of that money into some pockets of value, and we can still find a few in emerging markets despite the fact they have become very popular.
Are different markets pricing different effects?
I think they are. In essence, what you've got is equities pricing this really good solid growth environment, whereas bonds are sort of pricing this very low inflation environment. And one could say that there'll be a reconciliation, and sort of there was in the September period where the Fed started warning that they're going to be a little bit more hawkish and that markets were underestimating the chance for rate rises. However, if we sort of step back from it and say maybe growth is okay, inflation doesn't trouble too much, you do have the opportunity where equities can keep grinding higher and bonds needn't sell off. So they are pricing different effects. There could be a reconciliation, but there doesn't have to be as long as policy settings by the central banks don't move dramatically. If they start to harden their rhetoric towards tapering and more aggressive rate rises, that will have quite dramatic effects on asset prices.
Okay, so when it comes to places like emerging markets, Asia, are you still increasing your positioning?
Very marginally. We're tending to buy the more value-orientated pieces in the emerging markets and things that have lagged, particularly in Asia and emerging markets. We've still got quite a big position in India, which I think is about 4% or so. And we still like a number of the Asian markets. But as I say, the funds we've been buying, which really include strategies that have more value bias and a bit more mid-small cap bias, really have lagged quite badly this year, and we think they could play some catch-up if, obviously, growth continues on the route we expect.
And looking at Europe, is sentiment still strong, considering there was quite a disappointing result for Merkel in the elections and considering what's happening in Spain at the moment?
Yeah, it's been a tough old time, and obviously we've got an Italian election out there at some stage. But, I think, look, valuations were supportive, earnings growth's been strong, growth overall's been strong, Germany's really booming away. And people at the start of the year were very underweight euro. They've got very overweight euro. They bought a lot of European equities. I think the backdrop's okay. There are issues, and obviously Merkel and the election, that's got to all get sorted out. But sort of the shorter term reaction was for the euro to sell off a bit. So maybe most of that's priced into the market at the moment. We are marginally overweight at this stage.
Is the UK still out of favour with investors?
Yes, back onto our home market, which we probably overanalyse a little bit. But so that's been interesting. Everyone was pretty much down on the UK and thought there was no real good news story there. And we were quite positive on sterling, and we were overweight sterling-based assets for a long time. Now, just prior to this Tory conference, i.e. sort of September time, we did reduce that quite dramatically because we were just fearful that government policy, in particularly towards Brexit, doesn't appear particularly coherent or well managed. And we just feel that international investors will look at that, be doubtful that the pound can retain its strength. Now, the only other counter to that is growth's been fairly resilient, inflation has picked up a bit, and the Bank of England are talking about putting rates up. So that's sort of a little bit of support for sterling, so it needn't sell off too much further. However, when I look at the underlying statistics, and one thing that is really worrying me is real wage growth is basically negative in the UK because of the factors we've just discussed. It doesn't really augur well for the Bank of England putting rates up more than maybe once or twice. Yeah. So overall, are investors positive? It's a reasonable value proposition. There's a lot of risk associated with it, and Brexit, and will the Tory government basically be able to carry on? Or will there be a new election sometime called? At the end of the day, I sort of think people will retain their underweight, and we are sort of just underweight, I think.
So are the markets priced for risks? I'm thinking of what's happening in North Korea, Catalonia, even President Trump.
I don't think equity markets, they seem amazing. Look, maybe you'll accuse me of being a bit pessimistic, but they seem amazingly resilient to me. Every little worry that is out there is just dismissed. They barely budge. This has been a record-breaking run for the S&P 500. I think you've almost, if it goes up another month, you'll have to look back something like 50 years for this unbroken track record of gains. So are they pricing those risks? I don't think they are. I think when the rhetoric between the US and North Korea started escalating, we got a little feel for what might happen, where bonds were rallying and equities just started to sell off a little bit. I don't think they're overall priced for risks, and that's why we're comfortable spending a little bit of money on protective strategies.
Right, so all things considered, how are you positioned for Q4?
We're still overweight equities. We've still kept our bond duration a little bit heavier than the average guys in the sector. And generally, we're disposed to this sort of tug-of-war probably continuing for a while yet. But very positive environment as long as central banks give clear and coherent messages. And I think I've been warning in lots of my publications, really the danger is, in particularly sort of the Fed messaging, well, look, we don't understand what's going on with inflation, but we're going to carry on putting rates up anyway. Well, that doesn't really make sense to me and seems a bit ideological rather than practical. So the danger is something goes wrong on that front, i.e. policy error unseats something, and I would imagine that's more likely to be equities than bonds at this moment. So there it is. As I say, disappointment that we had a tough time in, particularly in September. We've already got some of that back. We think, in essence, that might have been a reversionary moment in markets, and that we will be able to get back that short period of underperformance. And actually, overall, we're pretty optimistic on the outlook. The caveat, as always, there is one, is just that central banks give clear messaging, give markets time to prepare, don't over-tighten.
Mark, thank you.
Thank you very much, Jenny.